Public Company Accounting Oversight Board. Meeting these requirements is very costly. Double taxation. A major disadvantage of the corporate form of business is double taxation. Because a corporation is a separate legal entity, its earnings are subject to federal and state income taxes, which may be as much as 35% of corporate earnings. If any of a corporation's after-tax earnings are paid out as dividends, the earnings are taxed again as income to stockholders. In contrast, the earnings of sole proprietorships and partnerships are taxed only once as income to the owners. Limited liability. Limited liability restricts the ability of a small corporation to borrow money. Because creditors can lay claim only to the assets of a corporation, they may limit their loans to the level secured by those assets or require stockholders to guarantee the loan personally. Separation of ownership and control. Just as limited liability can be a drawback of incorporation, so can the separation of ownership and control. Management sometimes makes decisions that are not good for the corporation. Poor communication can also make it hard for stockholders to exercise control over the corporation and even to recognize the management's decisions as harmful. Equity financing. Equity financing is accomplished by issuing stock to investors in exchange for assets, usually cash. Once the stock has been issued to them, the stockholders can transfer their ownership at will. Large corporations have millions of shares of stocks, thousands of which change ownership every day. They therefore often appoint independent registrars and transfer agents, usually banks and trust companies, to help perform transfer duties. The outside agents are responsible for transferring the corporation's stock, maintaining stockholder records, preparing a list of stockholders for stockholders meeting, and paying dividends. Two important terms in equity financing are par value and legal capital. Par value is an arbitrary amount assigned to each share of stock. It must be recorded in the capital stock accounts. Par value usually bears little, if any, relationship to market value of the shares. For example, although Google stock initially sold for $85 per share, the market value is now much higher. Its par value per share is only $0.001.
Yeah. Is that a lot of money? 0.001.
No,
Is that more or less than 1 cent?
that is less than 1 cent.
Absolutely. So happy that you recognize the little technical area. Okay. Uh, it's something that you can ignore and think that it's unimportant. But even though it's less than 1%, when you multiply by millions of shares, it's a significant amount of money. And decimals can lead to distortion if you don't really understand how they work and what they represent.
Multiplied by the par value. It is the minimum amount that a corporation can report as contributed capital. For example, even though the total market value of Google shares now exceeds 200 billion, Google's legal capital is only about 300, 325,140. To help with this initial public offering, a corporation often uses an underwriter, an intermediary between the corporation and the investing public. For a fee, usually less than 1% of the selling price, the underwriter guarantees the sale of the stock. The corporation records the amount of the net proceeds of the offering in its capital stock and additional paid in capital accounts. The net proceeds are what the public paid less the underwriter fees, legal expenses, and any other direct costs of the offering. The
Now,
cost of forming.
sorry, before you go on, Andrika, let's go back to that legal capital. What was the calculation again that we use in order to determine the outstanding shares for Google? How did we calculate it?
The number of shares times par value.
Yeah. What was the par value in this example?
The less than 1 cent.
Yeah,
So
0.001
yeah,
times.
300 and oh, that's million. Okay, 325.14 million shares.
Okay. And how do we get that 325.14 million?
That's just the number of shares.
Okay, times the 0.001.
Mm-hmm.
And so if we multiply 325.14 million shares by 0.001, what result do we get?
325,140.
Indeed. So yeah, even though it's only 0.001 and 40 million is a lot of shares, because of the 0.001 being so small, it still ends up being a significant number. All right, $325,140. And so we have to always be aware of those things. Okay, keep going.
The cost of forming a corporation are called startup and organization costs. These costs include state incorporation fees, attorney fees for drawing up the articles of incorporation, the cost of printing stock certificates, accountants' fees for registering the firm's initial stock, other expenditures necessary for the formation of the corporation. Theoretically, startup and organization costs benefit the entire life of the corporation. For that reason, a case can be made for recording them as intangible assets and amortizing them over the life of the corporation. However, a corporation's life normally is not known, so accountants expense startup and organization costs as they are incurred.
Question, anyone? Why is the corporation's life not known?
We don't know how long the company is going to last.
No, we don't. It could be 1 week or hundreds of years. All right. So we don't really know how long the company will be in business for. And therefore, since it's a separate legal entity like a person, a legal person, we cannot predict its lifespan. And so amortizing it, trying to estimate the life of the corporation to amortize it like depreciation is not a good idea. Hence the suggestion that any costs that are incurred to incorporate the company should be expensed immediately, and do not make any effort to amortize them because we have no idea what the useful life of the corporation might be. By the way, you guys handled the depreciation question pretty well, some of you. Okay? I thought that some persons might have gotten confuddled, but didn't look like you were confuddled. A lot of you looked
Depreciation was probably like the easiest thing to do.
the depreciation.
Yes.
That's good to hear because it's interesting how my easiest question. Okay, different strokes, clearly, for different folks. Okay, keep going.
Advantages of equity financing. Financing a business by issuing common stock has several advantages. Decreased financial risk. Issuing common stock is less risky than financing with long-term debt because a company does not pay individuals on common stock unless the board of directors decides to pay them. In contrast, if a company does not pay interest on long-term debt, it can be forced into bankruptcy. Increased cash for operations. When a company does not pay a cash dividend, it can shift the cash Google, for instance, does not currently pay any dividends, and its issuance of common stocks provides it with funds for expansion. Better debt to equity ratio. A company can use the proceeds of a common stock issue to maintain or improve its debt to equity ratio. Disadvantages of equity financing. Issuing common stock also has certain disadvantages. Increased tax liability. Whereas the interest on debt is tax deductible, the dividends paid on stocks are not tax deductible. Decreased stockholder control. When a corporation issues more stock, it dilutes its ownership. Thus, the current stockholders must yield some control to new stockholders.
Thank you very much, Enrico, for the moment. I'll be back, of course. I think Jerry must have orchestrated this thing where he doesn't have a mic, so he can bypass the reading session today.
Very clever of him.
Is that a correct summation, Jerry, or I got that all wrong? No, that's not it. Okay, we'll take your word for it today. All right, so let's look at the applied question. Do you guys ever look at that, like when you're reading or reviewing? Apply it. What is the question in this applied question? Anyone? What are they asking you to do?
To match each item that follows with the topic to which it pertains.
Okay. So, A, what is an advantage of the corporate form of business? Out of the 5 given.
Ease of ownership transfer.
Yeah, ease of ownership. Does anybody remember what that was? Is ease of ownership transfer? Anybody remember what that is? Somebody just read it earlier. Natasha, I think.
Yes, that's when buying and selling of shares of stock without affecting the corporation's activities or needing approval of other owners.
Absolutely. Remember, for partnerships, certain partners want to do something. I mean, they can go ahead and do it, but generally the proper protocol is to get approval and feedback from the other partners. In a corporation, if you own shares, you don't need to go to the board of directors or the management and say, I would like to sell my shares. Just go to a broker anywhere. There's a licensed broker and tell the broker you want to sell your shares. And that's it. So now you will get cash for your shares, and whoever bought them, they will now be the new owners, part owners of the corporation. So that's one advantage. What about number 2, disadvantage of the corporate form of business? What is a disadvantage?
The need to deal with government regulation.
The need to deal with government regulation. Definitely. You have to pay taxes, you have to pay VAT fees, you have to pay state and local taxes, and all this kind of stuff. So many corporations see that to be a pain in the butt, but it's a necessary evil because if they do not satisfy the government will shut them down. And if anybody's personally liable for not making it happen, they may even be in prison. Okay? I don't know if I told you, I have one son who lives in New York, God forbid. I don't know how that happened. And then my baby lives in Canada now and doesn't look like he's coming home. I don't know how that happened. But anyway, these are all tax intense. The cost of living in New York is not easy. And of course, you may or may not know in Canada, the tax rate can be anywhere between 30 and 50%, depending on which tax bracket you fall into. Of course, in Canada, education and healthcare, that kind of stuff is completely free once you have a medical card. So I guess that's some consolation for taking so much of your money. All right, what about number 3, dividend policy? Which one would you say?
3, dividends will be distributing cash to stockholders.
Yeah, distributing cash to stockholders. Remember in our reading and discussion earlier, only which of the three groups can declare dividends? Shareholders, the board, or management?
Shareholders?
No, the shareholders cannot declare dividends. They
Oh,
are,
declare, oh,
board.
the directors, the board.
yeah, only the board. The shareholders are the owners. They cannot declare dividends. The management runs the day-to-day. They cannot declare dividends. Only the board of directors can do that. Okay. Interestingly enough, Andrika, as she was closing her reading, she mentioned something about Google not paying dividends, which is quite interesting. A company that large is not paying dividends yet. And of course, part of the reason for that is they're keeping all the money in the company to do all the crazy things that Google does. The shareholders hang on to Google shares because the value of the shares are very high. Okay. Um, does anybody have a phone nearby? Anybody can get into Google?
Yes.
Type into Google the cost of one Google share today.
Okay, so that's $2,713.60. And it went up 0.17%. So it went up $4.62 today alone.
Absolutely. Probably the highest stock value anywhere in the world. There might be a stock value somewhere higher than that, but I doubt it. 2,700 for one Google stock. So if you want to buy one Google stock today, you need to find yourself $3,000 for one.
One.
Absolutely incredible. That's how high the market values Google and the kind of money and presence it has in the international market. Okay? Mind boggling. Let's compare it to something else, Andrika. Go back in and type in the cost of one Microsoft share today.
Okay. So Microsoft is $296.77.
There you go. Interesting difference, right? Now we know that Microsoft is a multi-billion-dollar company as well. The difference is Google caters to a different market, and Google is kind of like the new kid on the block compared to Microsoft. Microsoft has been around from the 80s, so it's kind of maturing in the market. And so even though $300 is a great price for the share stock, compared to Google, there's just no competition.
Amazon is $3,187.75.
There you go. Thank you very much. Way to go. Only Amazon perhaps has a larger per share value at the moment than Google. Okay. Try something else, Andrika. Try this. Which company in the world has the highest per share value? Let's see if anything comes up.
Okay. So I don't even know what this is. Berkshire Hathaway Incorporated.
Interesting. Do they have a little write-up on it?
Yeah, they have top 5 highest price stocks in America.
Okay. And what else?
This was released on August 10th of this year. And whoa, that cannot be real. Berkshire, a company that I've never heard about, has a stock price of $433,000. No, I said that wrong. $433,789.38.
My.
I've
Who
never heard
followed
of this
Berkshire?
company. NVR Incorporated, and they follow with $5,180. Then number 3 is Amazon. Number 4 is Alphabet Incorporated.
Yes.
And number 5 is Bookings Holding.
Absolutely. And some of these names are not even known to us. Okay. Uh, um, Berkshire, I believe, is one of Warren uh, companies, one of many, is a multi-gazillionaire or something like this. But yeah, that kind of gives you an idea of the individual stock values of these companies, some of which you've never even heard about, which means that they make gazillions and gazillions of dollars on the international market. Mind-boggling amounts of money. Uh, the guy who owns Amazon, what's his name again? Bezos, Jeff.
Yeah,
So,
Jeff
yeah,
Bezos.
Jeff and his wife divorced a couple of months ago, late last year, early this year, some crap like that. And she got a significant amount of the Amazon returns because, of course, when they got married, he was not that rich yet. He started working in his basement and then became this huge thing, just like Microsoft. Okay, so walked off with like tens of billions of dollars, money that will not be spent in several generations. Okay, so the point is, it's interesting to see how these share values work and as high as they can get per share in the market. Mind boggling. All right, thank you, Andrika. Cheryl,
Hello.
okay. Page 496. Your discussion will be the components of the stockholders' equity. What makes it up? What is it all about? How does it look?
Components of stockholders' equity. In a corporation's balance sheet, the owner's claim to the business are called stockholders' equity. As shown in Exhibit 2, this section of a corporate balance sheet usually has at least 3 components. Contributed capital, the stockholders' investments in the corporation. Retained earnings, the earnings of the corporation since inception, less any loss, dividends or transfers to contributed capital. Retained earnings are reinvested in the business. They are not a pool of funds to be distributed to the stockholders. Instead, they represent the stockholders' claim to assets resulting from profitable operations.
Okay,
Treasury.
before Cheryl goes on, let's see if we need to clear up retained earnings. Is there anybody who does not understand yet the concept of retained earnings?
I guess it is what it says. As when the earnings is retained in the company.
What does that mean when the earnings are retained in the company?
Okay, the profits that the income that the company make is not distributed among the shareholders, but it remains in the company.
Correct. Question, is it income or profits that you make?
Profit,
Is there a difference between income and profits?
yes, you can make income, but it may not be profitable.
Okay. Cheryl, I hope you've enlightened the others who are listening because that is a very important concept that a lot of people have no idea about, nor do they understand. Right? Income and profit are not the same. You could generate income and still not make a profit. In order to make a profit, what has to happen? Use the homework question you did for the income statement and tell me. In order to make a profit, what has to happen?
Your assets must,
Revenues must exceed your expenses.
Your revenues must exceed or be greater than your expenses. That's how you make a profit. If your expenses are greater than your revenues, you will suffer a loss. And if you keep suffering losses year after year, soon you will not be in business because you cannot continue to lose money and stay in business at the same time. Some companies have been able to do that for a while. They use overdraft facilities and borrow money for as long as they can until they cannot hold on any longer, and then they funk. The point is, every company is in business typically to make, especially at least for-profit companies, to make a profit. And so we're constantly, that's why wherever you work, You would hear them talking about cutting costs all the time. Don't buy too much toilet paper. Don't waste the hand towel. Don't do this. We can't pay that magnificent salary because it's going to be too costly for the firm in the long run. And always watching costs because they're always looking to what? Maximize profit for two reasons. Profits go to shareholders. Profits are kept in the business to help to run it from day to day. Both are very important parts of profit. All right, keep going, Cheryl.
Treasury stock. Shares of the corporation's own stock that it has bought back on the open market are called treasury stock. The cost of these shares is treated as a reduction in stockholders' equity. By buying back the shares, the corporation reduces the ownership of the business.
Okay, now before Cheryl goes on, let's look at Exhibit 2. Did anybody look at it before now? Out of curiosity, at least? No, I'm the only one who looked at this out of curiosity.
Yeah, I looked, but it didn't mean nothing to me.
Cheryl, you know what? You know what? I love it. When it means nothing, you just let it rip. I like that. Because sometimes folks act like it meant something, and really they don't know what the hell it is. So I love it when you say that because then we can try and sort it out, as opposed to me presuming that you know and move on. That would be a tragedy. All right. So remember in your homework, I gave you a bonus question, and one of the statements that you had to include to get points was balance sheet, correct? Uh-oh. Correct? Not correct?
Yes, correct.
Okay. Now the balance sheet, if you're going to get all the points you needed, had to include three main sections. What are they?
Assets and liabilities.
Liabilities and capital.
Yes, but for a company, we don't call it capital anymore.
Owner's equity.
No, for a company, we don't call it owner's equity anymore. Remember, we're in the corporate form of business, so we don't call it capital and owner's equity anymore. What do we call it?
Contributed capital.
That's part of it, but that's not what we call it. It has a special name, right? In Exhibit 2.
Stockholders equity.
Yes, stockholders equity. So on the left-hand side of the balance sheet, you'll have all the assets. On the right-hand side at the top, you'll have all the liabilities. And under the liabilities, you will have all of the stockholders equity components. And all this means is those things that make up the ownership of the company. That's all this particular section of the balance sheet means. Just like in a partnership, remember, the partnership capital made up the equity. In a sole proprietorship, the owner's equity made up the equity. In a corporation, still more complex, that's all, but it's the same principle. All of these things together make up the equity of the corporation called stockholders equity. Okay? I'm sure you can see a question on that one because it's such an important part of the corporate structure. So let's release Cheryl from her doubt and like whatever the hell that is. I don't blame her. When I saw it for the first time, I thought the same thing. All right. So what is the first component of the stockholders equity? What is it called?
Contributed capital.
Yes. And there are two other components, main components of stockholders equity. What are they?
The retained earnings and last the treasury stock.
Yeah, treasury stock. And not all companies have treasury stock. All right. That's something you need to know. But if it has treasury stock, then it'll be sitting right there where you see it. If it doesn't have treasury stock, the world does not come to an end. You just won't see it there. Okay. So in this example, Let's start at the top with contributed capital. Notice the description. And please, at least for the purpose of this particular chapter and this part of the semester, pay some attention to the descriptions, because how well you read them and understand them will help to determine whether you get good points on the test. So under contributed capital, what is the first item that we have to account for?
The issuance of the preferred stock.
Yes, this company has issued preferred stock, and we'll see later on what preferred stock is all about. It preferred kind of tells you in a way, but you'll see exactly what it is later. And since it's preferred stock, it's listed first because it's preferred. It has rights over other kinds of stock like common stock. So this preferred stock that was issued at what par value?
$50.
$50. And how many preferred shares were authorized and issued and outstanding?
2,000 shares were authorized.
Issued and outstanding.
Outstanding was 100,000. Am I reading this
Well,
correctly?
I'm so happy you're saying this stuff because this is exactly where folks get stuck. All right. What we're trying to do in the first instance is to find out where the $100,000 came from. And the $100,000 came from 2,000 shares of preferred stock at $50 per share. Does everybody see that?
Right.
That's where the 100,000 comes from. And that matter is closed. Believe it or not, it's that simple. Then the second part of the contributed capital is made up of
Common stock.
common stock. How many shares of common stock are authorized?
60,000 at $5.
The 60,000 at $5 is authorized. How many are actually issued?
Issue 36,000.
No.
Let me, no,
40,000.
40,000.
Yeah. And how many of them are outstanding?
36,000.
Okay,
Oh.
36.
We have X amount authorized, X amount issued, and X amount outstanding. That's an interesting situation. Therefore, how did we get the $200,000 of common stock in this stockholders equity account?
You only account for what was shared.
Meaning,
Issue date.
Yeah, that was issued, the 40,000, that was issued.
okay, 40,000 issued. So how do we get the 200,000?
You multiply 5 by
40,000 times
40,000.
5.
That gives us 200,000.
Yes.
Okay, I just want to make sure you guys are certain, so that when you see something like that in the test, you wouldn't say, which one of these? You'll be certain. Yeah, it's the 40,000 shares that were issued times the $5 per share.
I do have a question though.
I was hoping, yes.
If it's the same, we haven't gotten into the detail of preferred stocks, but that's saying that your share value could differ in the same company. Like, can Google sell me a share for sell it to you for $100?
Good question. Man, that's a great question. Let me answer it this way, Andrika. If Google has a par value, that's a legal dollar value for accounting purposes of, let's say, $100 per share, correct? Google could sell it at $100 per share if it wants to. However, remember now, the market value for Google is what? Very high, isn't it?
Yes.
So Google will not sell it for the par value or the legal accounting value. Google will seek to sell it for the market value, whatever the market will pay. And you already saw earlier when you did a little Googling of your own, how
Mhm.
high an individual share could be for a company like Berkshire and Google and Amazon. All right. So normally, and here's why it's a good question. Normally, the par value that we see here in the financial statement is never the same as the market value. How's that?
Okay.
And companies are always going to sell wherever possible at the market value. Okay?
Yeah.
Excellent question. It's just like if you had a car for a long time and you love it, and when it's time to sell it, because you love the car, that's your favorite car. You've had it for 12 years. That's your baby. Saw you through the pandemic, through Dorian, all this stuff. So you have a sentimental attachment to that car. So when the time comes, you want to sell it for, let's say, $13,000 because that's what you think it's worth to you. That 13,000 that you think is worth to you is equivalent to the par value because you set that price, correct?
Yes.
But in the market, when you go to Natasha or Cheryl and said, I'm selling this for 13,000, they're going to be like, are you out of your mind? The market value for that is only about 3,000. And so even though you want 13, the market will determine what it will be sold for. You follow? And it's the same thing with the par value versus the market value of the shares.
Okay. Yes.
Good point. All right. So now we see where we got the $200,000 in outstanding dollar value for our common shares. What about the other item on the common shares? What is that called?
Additional paid in capital.
Yeah. Did anybody figure out how we got that 100,000 or that just appeared there? For the hell of it.
Yeah, why is that there? Weren't some shares authorized and issued and others were outstanding? Why are we adding both of them?
Well,
What's the
first of
difference
all,
between authorized and outstanding?
I was hoping somebody would raise that question. Authorized means that that is the amount of shares that the government or the registrar has authorized or given you the authority to issue. That means you cannot issue any amount of shares over and above.
Okay, you can't exceed that.
No,
Okay,
you can't. All right. So even though you may be authorized to issue 100,000 shares, you may only issue 50,000. So whatever you issue would be the outstanding, even though your authorized is 100,000. Make sense? Sarah?
not quite. Okay, we see 60 shares were authorized.
You're attaching the example to this question now. Okay.
40 shares issued.
So let me ask you, how many shares did the government authorize this company to issue?
60,000.
Can they go over that?
No,
No, certainly not without approval. They can't. How much did they issue?
they issued 40,000.
So if they issued 40,000, then all things being equal and nothing else happening, how much would be out there?
20.
No?
If issued, okay, so if 60 was authorized and 40 was issued,
Right? So
won't there
remember,
be a remaining balance of 20?
well, it'll be up 20,000 available to issue if you want to. But how much would be in the market?
I lost.
Can anybody help Cheryl?
Mm,
They say, me neither. Well,
no.
let's, let's, let's back up again, Cheryl. You go to the Registrar General, tell them you're opening a company and you need them to authorize 60,000 shares because you don't have to issue more than that, right? So they stamp it authorized.
Right, it's authorized.
Now, issued means those are the shares you sell. So if you issue or sell 40,000 shares, How many
40
shares?
from the 60, right?
Yeah,
40 of the 60,000.
yeah. If you
Mhm.
sell 40,000, how many
Mhm.
shares? How many of your shares are in the market?
40,000.
Yes, absolutely. And how many more shares you have available to sell if you want to?
20,000.
That's it.
That's what I was saying, I thought.
So how,
Where does
what's it say?
36,000 come
36
from?
shares outstanding.
Well, see, you guys are making the other mistake I was hoping you'd make. Don't mix up the number of shares with the dollar value. We were only talking about the number of shares so far.
That's still the number of shares.
They said there remain 36,000 shares outstanding.
I know.
Where does that come from?
Well, let's think about it. If you issued 40,000 and you have 36 outstanding, what's the difference?
That's about 4,000 different.
4,000.
What do you think that is? You probably don't get it yet because you just kind of read over treasury shares like it's just another narrative. Go back to treasury shares and see what it says.
Oh, they redeemed it. They
Well, it depends on what the definition of
they
treasury
repurchased this. Okay, treasury stock can be repurchased.
Remember I told you in accounting? Don't just like scoot over it because sometimes it comes back to haunt you. Absolutely. They redeemed how many shares?
36.
No.
Bought.
How many did they issue?
They
They
issued 40,000,
How many are outstanding?
36,000.
What happened to
They
the other
they
four?
redeemed 16,000.
So they bought back 4,000.
They bought back 4,000. That's all.
okay.
That's it.
Okay, that's the magic bullet right there. Okay.
There you go. That's the magic bullet. Okay. So now that we get the shares out of the way, let's go to the dollars. We already determined where the 200,000 came from, didn't we?
Yes.
So where did the 100,000 come from? What is the 100,000 called?
Additional paid in capital.
Indeed. Have we seen that expression in our reading yet? So far? Anybody recall seeing that expression so far in our reading? Additional paid in capital? Any definition given for that?
No.
No, not yet. Okay, so now we know the par value of the shares of the common stock is equal to $200,000. How did we get that again?
We multiply 5 by 40,000.
Yeah, we multiply $5 par value by the 40,000 shares that were issued. That gives us $200,000 in outstanding common shares. This additional paid in capital, you'll see sometime later, is an amount that is paid over and above the par value. So what is the par value?
That's the value of the share.
That's the value of each share of common stock. Additional paid in capital would be an amount over and above that. For example,
Okay, anything that exceeds it.
anything that exceeds the par value creates the additional paid in capital. In this example, $100,000.
So
Mhm.
did that have to be calculated? Or do they
Depends.
give us that figure?
In this case, it is given. In practice, it will have to be calculated.
Okay.
Okay. I suspect you will see the calculation somewhere before your accounting life is over this semester.
Okay.
But yeah, if it usually is calculated, but it can be given. Let me give you an example. Let's say you issued 40,000 shares at par value $7 per share. What is the dollar value?
That's 280,000.
Correct. Now, suppose I said that instead of issuing them at par value, we issue them, let's say par value is 7, we say that they were issued at $9 a share. Now we have a situation. First of all, we have to calculate the par value of $7 times 40,000, which is 280. And how much is the amount above par?
360,000.
No, how much is the amount of dollars above the par value?
So above par was $9. You asking me for the difference, or you asking me for
The difference.
the difference is $5?
Par
What?
value is $7.
Oh, $7, $2.
$2. And so the amount above par value at $2 will then be multiplied by the number of shares, which is,
40,000,
which equals,
80,000.
that would
So-
be additional paid in.
Okay, anything that exceeds the value.
The par
The
value,
difference. Okay,
anything that exceeds the par value.
the power value.
Yes. Okay. So there you have it. In terms of common stock plus additional paid in, we have 2 plus 1. So the total common stock outstanding in dollars is how much? Common stock. Remember, common stock is made up of 2 components. How many shares have been authorized? How many shares have been issued?
40,000.
Times what par value?
$5.
Equals?
200,000.
What's the other part of the common stock?
The additional paid in capital,
What's the value of that?
100,000.
So together, they total.
300,000.
So the common stock then has a value of 300,000 that we carry over. So when we add up all the contributed capital amounts, we have, first of all, preferred stock, which is,
100,000.
and common stock, which is,
200,000.
how much?
200,000.
Common stock is 300,000.
Common stock is 300,000 in total. Remember, common stock.
Don't you put those separately? No? You don't put it separately, common stock and additional paid in capital?
They are
You don't
separated.
separate them? Or
They
you
are
just,
No, they are separated on the indent so that you can see the 2 separate parts. But the total is carried over to the right-hand side. You see that?
yes. Which says 300,000.
Correct. So yes, they are separated so you could see that part of the common stock is the authorized shares that have been issued, and the other part is the additional paid in capital. But for totaling purposes, we have to add them together for total common stock outstanding of $300,000. So therefore, total contributed capital becomes
400,000.
absolutely. And that's usually the most challenging part of the stockholders equity for students until they get it. The other part is retained earnings, correct? How much is that?
$120,000.
Where did that come from? Where did that 120,000 come from?
Would that be the balance from the prior year
And including the current year.
and the
All
current
of the
year
profits from the previous periods plus
and the current?
current period. In this example, it is presumed to be $120,000 because that is what would be sitting in the general ledger account. Anybody remembers that account again? General ledger, remember that? Uh-huh,
Yes.
absolutely. For the retained earnings that you see here of 120,000, what would be the name of the general ledger account for that particular item? I know, the obvious. The name of the account would be retained earnings.
Oh,
Remember, what is a general ledger account? It is an individual account for every single transaction in accounting. You follow? All the asset accounts, all the liability accounts, all the equity accounts, they all together form the general ledger. And each account sitting in there is a general ledger account. Okay? Keep that in mind. A lot of times students disconnect them for some reason, but they're not to be. A general ledger is a total of all the accounts, and each account is referred to individually as a general ledger, and each one of them has a name that is either an asset, a liability, equity, revenue, or expense account. Nice little tidbits to know. Is this stockholders equity account finished?
No,
After we add contributed capital plus retained earnings, what is the total stockholders equity so far?
520,000.
Okay, but we're not done. What's the third part of this stockholders equity account?
the less the treasury stock,
Yeah, we subtract treasury stock of how much?
4,000 at cost.
4,000 of what?
Cost,
What is cost?
um, at $5 pie value,
Is it?
isn't it?
I don't know, 4,000 times $5 equals?
20,000.
So it isn't that then.
I wonder what that is.
Isn't that the difference between the 40,000 and 40,000 issued and the 36 share outstanding?
It is. It is the difference. So you started off by issuing 40,000, but you bought back 4. So now you only have 36,000 outstanding, and you have 4,000 sitting in the company's treasury account. The
Yes,
question
yeah.
is, where did the 40,000 come from for the treasury stock? Well, if we divide 40 by 4,000 shares, what do we get? 40,000 by 4,000 shares.
Ten.
Get $10.
$10. So
Oh, that's the okay, that's the difference with the additional paid in capital value aid.
you could say that, but what it means more importantly is that when you go to buy back your shares from the market, you can buy it at your par because nobody cares about your par. If you want to buy from the market, you have to buy it at what price?
Okay, that was the market value at the time of repurchase.
Absolutely. Couldn't say it better myself. Okay, excellent. All right. So once we account for the reduction in outstanding shares called treasury, what is now the total stockholders equity?
$480,000.
Indeed. If we had not redeemed the shares, what would be the equity balance?
$520,000.
Absolutely. The prosecution rests on that particular exhibit. Okay. I would encourage you to look it over again after class to try to see if you can get it to stick somewhere. Don't leave it again until it's time to study for the exam. So, oh
Yeah, it's still clear as mud.
yeah, exactly. Did we actually do that? And the answer would be, we sure as hell did. We dissected it more than we dissect a bloody rat. All right. So make sure you kind of go over it a little bit. Uh, and again, on Saturday, we'll give you homework to help you, force you, push it down your throat a little bit so that you can get the practice and try to retain some of it. Okay, Cheryl, believe it or not, we're not done with you despite all that.
No,
Uh-uh.
there that was.
In keeping at the bottom.
Okay, in keeping with the convention of full disclosure, the stockholders' equity section of a balance sheet gives a great deal of information about the corporation's stock. Under contributed capital, it lists the kinds of stock, their par values, and the number of shares authorized, issued, and outstanding. Corporations may disclose more detail in a statement of stockholders' equity or statement of changes in stockholders' equity. This statement summarizes changes in the components of the stockholders' equity section of the balance sheet. A corporation can issue two types of stock. Common stock is the basic form of stock. If a corporation issues only one type of stock, it is common stock because shares of common stock carry voting rights. They generally provide their owners with the means of controlling the corporation. Common stock is also called residual equity, which means that if the corporation is liquidated, the claims of all creditors, and usually those of preferred stockholders, rank ahead of the claims of common stockholders. Preferred stock is stock that a corporation may issue to attract investors whose goals differ from those of common stockholders. Preferred stock gives its owners preference over common stockholders, usually in terms of receiving dividends and in terms of claims to assets if the corporation is liquidated. In addition to identifying the kind of stock and its par value, the description of contributed capital in Exhibit 2 specifies the number of shares authorized, issued, and outstanding. Authorized shares are the maximum number of shares that a corporation state charter allows it to issue. Most corporations are authorized to issue more shares than they need to issue at the time they are formed. Thus, they are able to raise more capital in the future by issuing additional shares. When a corporation issues all of its authorized shares, it cannot issue more without a change in its state charter. Issued shares are those that a corporation sells or authorized transfers to stockholders. The owners of a corporation issued shares own 100% of the business. Unissued shares have no rights or privileges until they are issued. Outstanding shares are shares that a corporation has issued and that are still in circulation. Treasury stock is not outstanding because it consists of shares that a corporation has issued but has bought back and therefore put out of circulation. Thus, a corporation can have more shares issued than are currently outstanding. Exhibit 3 shows the relationship of authorized shares to issued, unissued, outstanding, and treasury shares. For example, Google has 9 billion authorized shares of stock and only about 325 million shares issued. With its excess of authorized shares, Google has plenty of flexibility for future stock transactions.
Okay, thank you very much, Cheryl. And of course, Exhibit 3 shows you exactly what she just said. It's fascinating that they have 9 billion authorized.
I
Yeah, go ahead, Enrique.
so let's just say Google like starts to feel themselves and author or issue all 9 billion shares. Doesn't that like automatically decrease the value of a share?
Definitely, by a lot. So they're not
Okay.
likely, their board will not do that, and any board member who comes up with, including the chairman, will be shot on site. So
Got
just,
it.
that's a good point, okay? They only got authorization for 9 billion, so they don't have to go back for any more anytime ever. possibly. You follow?
Follow.
They could keep issuing as much as they want without running out of authorized capital. You see, once you meet your maximum authorized capital, you could get more, but you have to go back and make application. That's time consuming and expensive. Plus, it's going to cost you more money to get additional authorization. So if you get it up front, you don't have to worry about any additional costs in the future. You don't have to worry about being inconvenienced, going to get more at a time when you need to issue shares quickly so that you can raise money for certain projects and so on. So they've gone way above what the required amounts are so that they can be covered to issue as many shares as they want, almost into infinity, so to speak. Okay? I'm surprised they even allowed them to get an authorization of 9 billion shares. It seems so absurd. But for a company as big as Google, it's not absurd at all. All right. So, Cheryl, you got now to introduce yourself to your favorite categories, the difference between authorized, issued, and outstanding. Any more doubts? Cheryl? She said, man, I need a drink after that. I'm going to get some coffee. All right. Be very clear on the differences between authorized, issued, and outstanding, because when it's time to prepare that stockholders equity section of the balance sheet, or can transact other business, or even make certain journal entries that we'll see, if not tonight, on Saturday, how important it is to understand the difference so that you do not mess up the accounting information in your general ledger. See that word again. All right, Natasha, we're back to you. As Jerry continues to insist that he cannot speak, so he gets out of all this. But we'll get him on Saturday. Jerry, are you still there? Okay, way to go. Nobody's gonna accuse me of not being there. The mic thing is bad enough. Okay, Natasha, are you there?
Yes.
Okay, we're back to you. Natasha, characteristics of the preferred stock. Remember, where was the first time we were introduced to preferred stock? Recently.
The types of stock.
In which statement? What statement did we see preferred stock?
The stockholders equity.
Absolutely. You said it like you weren't sure. You were doubtful about that one?
No, I just was reading over to make sure.
Okay, way to go. That's what I was hoping you do. All right. All right, so let's pick up then on the characteristics of preferred stock. So that since it showed up first on the stockholders equity report on the balance sheet, it is a very important equity item for the company to properly maintain. Let's see what it's all about. Characteristics.
Most preferred stock has one or more of the following characteristics. Preference as to dividends, preference as to assets if a corporation is liquidated, convertibility, and a callable option. A
Yes.
corporation may offer several different classes of preferred stock, each with distinctive characteristics to attract different investors. Preference as to dividends. Preferred stockholders ordinarily must receive a certain amount of dividends before common stockholders receive anything. The amount that preferred stockholders must be paid before common stockholders can be paid is usually stated in dollars per share or as a percentage of the par value of the preferred shares. For example, a company might pay an annual dividend of $4 per share on preferred stock, or it might issue preferred stock at $50 par value and pay an annual dividend of 8% of par value, which would also be $4 per share. Preferred stockholders who have no guarantee of receiving dividends. A company's board of directors must declare dividends on preferred stock before any liability arises. The consequences of not granting an annual dividend on preferred stock vary according to whether the stock is non-cumulative or cumulative. If the stock is non-cumulative preferred stock and the board of directors fail to declare a dividend on it in any given year, The company is under no obligation to make up the missed dividend in future years. If the stock is cumulative preferred stock, the dividend amount per share accumulates from year to year, and the company must pay the whole amount before it pays any dividends on common stock.
Does everybody understand that difference? Because that's an important difference. I didn't hear anybody raise any questions, which leads me to assume that you get it. And that's good. But make sure you understand clearly the difference between cumulative and non-cumulative, because in the real world, it can result in millions of dollars being lost or gained, depending on which side of the fence you are on. Okay, keep going, Natasha.
Okay. Dividends not paid in the year they are due are called dividends in arrears. If a corporation has dividend in arrears, it should report the amount either in the body of its financial statements or in a note to its financial statements. The following note is typical of one that might appear in a corporation's annual report. On December 31st, 2014, the company was in arrears by $37,851,125 per share on dividends to its preferred stockholders. The company must pay all dividends in arrears to preferred stockholders before paying any dividends to common stockholders.
Okay, now we're into the nitty-gritty of the preferred stockholders and the dividends to which they are entitled. Because this is where the fights usually occur if there are any problems, errors, or misunderstanding. All right, so watch very carefully. Natasha, can you just read the transaction before I say anything else?
Harbatch Corporation has 20,000 outstanding shares of $10 par value, 6% cumulative preferred stock. Operations in 2015 produced income of only $8,000. However, the board of directors declared a $6,000 cash dividend to the preferred stockholders.
Okay, now we have an interesting situation. There isn't a lot of profit in this year. For some strange reason, with that minimum profit, the board decides to declare a dividend. Sometimes they do it because they're not very keen on what they do, and other times they know exactly what they're doing because they're declaring dividends so that they or people they know and others could benefit, even though that's not a good year to do it. But wherever there's money, strange things always happen. I'm not saying that's the case here. I'm just saying. All right. So how then do we compute the distribution of this $8,000? Well, first of all, we know from our reading that we have to pay the preferred shareholders when?
You have to pay them before the common stockholders.
Yeah, in other words,
Pay them first.
FIRST, yes. So we have to pay them first. And what is the agreement that the company has in terms of what they will pay preferred shareholders? What did they promise the preferred shareholders? So they say they will pay them in dividends.
$6,000 cash.
Well, well, before we even get to that, what is the agreement on how much will be paid to preferred shareholders, period?
Um, 6%.
6% of par value.
Cumulative preferred stock.
All right, 6% cumulative preferred stock. And that 6% is supposed to be 6% of par value based on earlier reading. Let's see if it's true. What is 6% of the par value in this transaction? Six percent.
6% means 6,000.
6%.
No,
That's up for the 20,000 shares at $10 each.
you guys,
That would be
I know, no, you're jumping the gun, and I know why. First of all, what is 6% of the par value?
6%.
The par
6%
value
of
would
the
be
par value
$10.
is
10.
6% is $6. Cause at
Times
60%,
Times, is how much?
wait, the par value is $10, right?
That would be 6% would be 60 cents,
60 cents times how many shares outstanding?
20,000,
How much is that?
12,000.
12,000.
Now we're getting warm. So now we can understand the first transaction of dividends that are payable to preferred stockholders. Do you see that?
Mhm.
In 2015, they agreed to pay the preferred stockholders dividends. Once they agree to pay them dividends, it has to be 20,000 times $10 times 6%, which is
12,000.
12,000. Based on that alone, do they have enough to pay them? Do they have enough profit to pay them 12,000?
No,
No. So what happens?
I guess,
What do they do? The second line, look at the second line, last 2015 dividends declared to preferred stockholders out.
okay, they'll have to pay the first 6,000.
Yes,
The balance would remain in arrears.
yes. Perfect. Does anybody not see what she's saying? That's all that means. No panic, no stress. All right, now look at the comment, Natasha. What does the comment say, Natasha?
Before the corporation can pay a dividend in 2016 to common stockholders, it must pay the preferred stockholders the 6,000 in arrears from 2015, plus 12,000 for 2016, for a total of 18,000.
Indeed. So come 2016, they have to pay the arrears of 6,000 first, and then the 2016 dividends of 12,000. So hopefully in 2016, the profit is what? Much more.
12,000.
No, not 12.
Exceed that.
Not 12, 12 plus 6. Remember, they have to pay the 6,000 plus the 12 in 2016, because they still have 6,000 outstanding from 2015. Plus 12,000 in 2016, that's $18,000.
You assuming that the company will be declaring 12,000 dividend in 2016? How could you predict that?
Oh, no. Remember now, the dividends that you're obligated to pay has nothing to do with how many profits you make. You're hoping to make enough profit to cover the dividends you promised to pay.
Okay,
That's how it works.
okay then. So that's
Right?
a set.
Yeah,
Okay.
it's set. Perfect. I'm glad you put it that way. Every year, the company is obligated to pay preferred shareholders by contract.
Okay, that's
6%.
nothing.
Yeah, nothing to do. If they lose money every year, too bad. They still
Oh, nothing to do with profitability.
well, if you're profitable, you could pay. If you're not, then
You have the liquidity to pay.
yeah, if you're not profitable enough, preferred shareholders are going to call on you
No
and
cash flow.
force you to liquidate and start selling assets to pay them. They're gonna go to the court just like any other creditor and say you haven't paid your preferred dividend commitments in 5 years.
Contract.
Absolutely. Common shareholders don't have that luxury. They are not on contract. They have to wait for it to be declared and paid. They can't do anything about it.
So you buy any shares, it better be preferred stock then.
If you have the money and the clout to buy that
I
kind
guess they go for a pretty penny because they are preferred.
yes, they are. That's why they are contractual and that's why they get preference over common. Okay, absolutely. So with that in mind, then, can somebody even begin with your limited knowledge to explain the next table? Well, first of all, what was the transaction in 2016? Natasha?
In 2016, Carbar Corporation earns income of $60,000 and wants to pay dividends to both preferred and common stockholders. The board of directors declares a 24,000 dividend.
Okay, notice it doesn't at 60,000, only 24. Where does the rest go? Cheryl, in your favorite account, where's that?
I a little lost right now.
Oh, how much profit did the company make in 2016?
Earn 60,000.
Correct. How much is being paid in dividends?
Oh, 24,000 is being paid in
Where's the
dividends.
rest going?
Where is it going?
Yeah,
It's going to the shareholders.
no, the 24 is going to shareholders. That's what
Oh,
this-
okay, will remain in retained earnings.
Your favorite account.
Let it stay.
Yeah, let it stay account. That's where it went. And that's where it'll stay until something else happens the following year. Uh, to let it stay account. Okay, so if the preferred and common are going to be paid dividends, preferred gets paid first, correct?
Yes.
Correct.
So we start off with the 24,000 that the board declares. The first thing that has to be paid out of the 24,000 is, let me see if you
The
got it.
preferred stockholders dividend and the rest for 2015.
Good. Doggone it, you sound like an experienced banker. Okay, the preferred from 2015 is paid first. Now, how much is left after that?
That will leave us with the 18,000 available for
Which is
2000.
going to be paid in 216 according to the contract for the preferred.
12,000.
And we already know how we came about that. And if you don't remember, just practice after class right away before it gets dull and you don't remember anything at all. But we remember how we got that 12,000. So after we pay 2016, how much is available for common shareholders?
6,000.
Yeah, lousy, stinky 6,000. But
Share that
that-
among y'all.
yeah, that's how it works. If you're a shareholder, a common shareholder now, preferred shareholders get preferred rates because they invest significant amounts of money and so on. Common stockholders do not get preferred rates, but they're allowed to vote. Preferred shareholders cannot vote. So if the board pisses off the common shareholders, they can complain to the if the board pisses off common shareholders, they can go call an emergency meeting among themselves and vote the board out. See my point? So the board doesn't want to piss off the common shareholders either, because they have the power to vote them out, just like.
Vote them out.
Hey, by the way, don't we have elections next month?
Yep.
Who's going to win?
Y'all didn't have the motorcade passing me earlier?
Motorcade already? That's what that was?
Yeah.
I thought we had a doggone curfew. They're trying to get in before 9. Yeah. Anybody knows who's gonna win the election?
We just hope it ain't Brave. That's what we hope. But we don't know. I mean, honestly, will the people be that upset with Minister put Brave in his place? Brave?
Guess what? I think Minister Boat to resign as leader.
I wouldn't want to do another 5 years if I was him.
Edrika,
Pass that baton to someone else. Then they
Edrika,
stand a chance.
Edrika,
Yes.
are you 30 yet?
I'm not 30. I'm probably the youngest one here.
Yeah, she say no Brave.
No. See, there's a reason why I said that.
Uh-huh.
You are not a Braves generation, but you seem to have a very keen insight into that matter for some reason. And the reason I say you have a keen insight, where did you get that insight from at such an early age?
I feel as though my generation is the one that wouldn't rock with Brave the most because of his mentality, or what we think is his mentality. He is of the oldest in politics right now. You know what I mean? He should not be running a country.
Of course, I know what you mean. That's not the only reason why, and I wouldn't say on national TV on this thing the other reasons, because there's some old reasons that go back. But it's interesting that your generation is able to even take that perspective, because that perspective has some significant value to those persons who know the truth about the truth. That's all I can say about that. I don't want anybody mess with my whatever. All right. So yes, we don't know how it's going to go. Nobody knows how people are going to vote. But I say sometimes in life you have to go with the lesser of two evils.
Well, you can't win if both evil.
Yes, you could.
With the devil and the demon.
That's okay. You sometimes you have to go with the
I
lesser.
used to use that argument, but I don't know much water
That's
weight
okay.
with me now.
Well, we don't have anything else. So we have to choose one. And if I'm going to choose one, I'm going to go with the lesser of two evils. That's a very serious situation, and Bahamians are going to be making a very serious.
Boy, you can't win with the lesser of two evils. That's both evil.
It's
I
not
don't get
about
that.
no. Remember now, nothing can be won on this earth, because the earth is already what? Corrupt.
Corrupt.
Even the
Well,
Bible.
corruption.
No,
Okay, now you want to break it down. Eh? Now we know corruption everywhere. You can't run a hide from it.
So you're always gonna have the lesser of two evils until who comes?
Jesus come, we gotta deal with them. Yeah.
Exactly.
You need say no more.
Okay, doggone it. Where were we? Dividends.
Don't preach to the choir.
Yeah, started preaching. Okay, well, but that's a very interesting insight, Edrika, for a youngster. That's fascinating. All right, stick to your guns. That's a very fascinating insight. There are a
That
lot
was the
of
scary part of it, Mr. Wilkinson.
what's
Is
that?
that people are so uncertain that they do nothing. No one vote. Very low turnout.
Yeah, that's true. That's the other issue. Either way, we're still dealing with the lesser of two evils, and then we're gonna have to decide which evil we're gonna end up with. Nobody knows, God forbid, because nobody knows what anybody's gonna do when they go in a dark voting booth. And so whatever comes out, we'll all have to live with it.
Gotta see God's face on this one. Gotta pray fast.
Well, a guy said one time ago, he was expressing his thoughts about something, and he said, "Oh Jesus, Joseph dead, we're in trouble." Anybody knows what that means?
No.
No. Once upon a time, there was a great leader in Egypt called Joseph. Remember him? What the hell?
A leader?
Yeah, Joseph, who led Egypt for many, many decades. Nobody remembers Joseph, who they threw in the pit and sold into slavery?
Yeah, Joseph.
Thought of many colors.
Yeah,
Yes,
Joseph.
he became a great leader, second in command in Egypt.
Okay.
And,
Okay,
and
Joseph.
that's where the Jews came to live for all the time that he was.
Right, that's why they were here.
Yeah, and then when he died, they became slaves.
Mm-hmm.
That's why the guy in Nassau said, "Oh Lord, Joseph is dead. We are in trouble." So what that means is, in modern terms,
Nope.
be careful what choice you make.
Or you remain in bondage.
Are you going to choose Joseph, or are you going to choose Barabbas? Okay.
Right.
I notice I didn't say who was Joseph and who's Barabbas. That's what you just have to decide. Okay. All right. So there you have it. How much is available for common shareholders again in this example?
6,000.
A lousy 6,000, but 6,000
Mm-hmm.
done nothing. And if they're not happy with it, and if the board doesn't declare some good dividends for them soon, they might very well come together at this extraordinary shareholders meeting and vote them off the board and get a new board who will hopefully pay them more dividends. All right, keep going, Natasha. You're almost there.
Okay, so with a preference as to asset,
Yes. I forgot where I was. Yes, exactly.
preferred stockholders often have preference in terms of their claims to a corporation's assets if the corporation goes out of business. If a corporation is liquidated, these preferred stockholders have a right to receive the par value of their stock or a larger stated liquidation value per share before the common stockholders receive any share of the assets. This preference can also extend to any dividends and arrests owed to the preferred stockholders.
So if the company is paid, preferred stockholders get paid first. If anything is left, then it will go to common. If nothing is left, too bad, dog eat their lunch. That's how it works everywhere in the world. Keep going.
Convertible preferred stock. Owners of convertible preferred stock can exchange their shares of preferred stock for shares of common stock at a ratio stated in the preferred stock contract. If the market value of the common stock increases, the conversion feature allows these stockholders to share in the increase by converting their stock to common stock. Suppose that a company issues 1,000 shares of 8%, $100 par value convertible preferred stock for $100 per share. Each share of stock can be converted to 5 shares of the company's common stock at any time. The market value of the common stock when the company issues the convertible preferred stock is $15 per share. The owner of one share of preferred stock purchased for $100, therefore has an investment if converted into common stock with a market value of about $75. The investor would not convert at this point, preferring to
Take a
receive
pen.
it.
Take a pen, Natasha. Why do you guys think the investor would not convert at this point? Why wouldn't he?
It'll be more profitable to convert later.
At what price? An amount greater than what?
Par value,
Exactly. At the moment, he's getting how much as a preferred shareholder?
$15 per share.
What's the par value?
The par value is $100.
So if he converts and he's getting 75, does that make sense?
Yes,
No,
No.
no.
Right? No. Keep reading, you'll see why. Keep reading.
The investor would not convert at this point, preferring to receive the 8% dividend. Now, suppose that in the next few years, the market value of a share of the common stock increases from $15 to $30. By converting each of their shares to 5 common shares, preferred realize $150, 5 shares times $30 per share, or a gain of $50 above the $100 they paid per share of preferred stock.
Say once the conversion will take you above the $100 you paid, then you're ahead of the game. It makes sense to convert.
Mm.
Follow
Okay,
everybody? As long as
okay.
the conversion keeps you under the $100 you paid, then it doesn't make sense to do it.
oh, because what?
Okay, okay.
So one preferred stock is equivalent to 5 common stock then?
Exactly.
Okay, at $30 per share.
Exactly. Absolutely. Perfect. Now remember, when it was at $15 a share, it would have been what? 5 times 15, right?
Right.
Which is under the 175. But once it goes
Mhm.
to 30, then it becomes 5 times 30, which is 150. And like, yes, this is a bloody profit. Let's go. I'm making money. And therefore, they would convert. And they would convert to common shares and then sell them. Do you follow?
Right.
So they would have made more on the conversion than they made on the original investment as a preferred shareholder. That's why it's attractive to some persons who purchase convertible um, preferred stock. All right, keep going.
Callable preferred stock. Most preferred stock is callable preferred stock. That is, the issuing corporation can redeem it at a price stated in the preferred stock contract. An owner of callable preferred stock that is not convertible must surrender it to the issuing corporation when asked to do so. If the
Keep
preferred
going.
stock is convertible, The stockholder can either surrender
Because when the company calls the stock, it means they're buying it back from the shareholder. And if they expect the shareholder to sell, they have to buy it back at a price higher than par, and certainly, hopefully, better than market. Because if they want to buy it back at a price lower, equal to par, then you don't have any incentive to sell. You don't make anything. If they want to buy it back at an amount that's lower than market, then that doesn't help you either. So typically, when a company calls or buybacks its shares, it tends to do it at or above market. Okay, folks? So that people will be, shareholders will be encouraged to sell. Okay, keep going.
For example, preferred stock that has a $100 par value might be callable at $103 per share. When preferred stock is called and surrendered, the stockholder is entitled to the following: the par value of the stock, the call premium, any dividends in arrears, the current period's dividend prorated by the proportion of the year to the call date. A corporation may decide to call its preferred stock for any of the following reasons. It may want to force conversion of the preferred stock to common stock because the dividend that it pays on preferred shares is higher than the dividend that it pays on the equivalent number of common shares. It may be able to replace the outstanding preferred stock with a preferred stock at a lower dividend rate or with long-term debt, which can have a lower after-tax cost, or it may simply be profitable enough to retire the preferred stock.
Indeed. Okay. All right. Thank you very much, Natasha. Remember, when we come on Saturday, we're going to make sure that Jerry takes all his licks. If he comes back to us with the fact that he has a mic that doesn't work again, we are not going to be happy about it. We're going to send the cops for him and force him to get a mic so that he can do his share. He got away with murder today, but he will not get away with murder on Saturday. All right, so you guys go ahead. If you haven't finished reviewing the remainder of the chapter, when we come on Saturday, we'll finish that particular chapter. I'll assign homework. By then, you'll have your exam grade. And if you have any questions about it, you're free to raise them at that time. Any questions before we break? All right, great. Remember, they say the Delta, Alpha, Omega, and every other virus is floating around. Please be careful out there. Don't take anything for granted. Remember, the virus does not discriminate. It doesn't know that it's your husband, wife, mom, dad, bestest sweetheart or friend, cousin, ally, colleague, whatever it is, pet. Just be careful and take the necessary precautions. And I'll see you guys on Saturday morning. At what time?
9 a.m.
9 a.m. sharp. All right.
Ciao.
Absolutely. Enjoy the rest of it. I'll see you then.
You too. Good night, all.
Evening.
All right,
Good
take
night.
care. Good night.